Welcome back to the Hurdle Rate. I'm Tim Kotzman. I'm here with Ben Workman, Matt Cole, and Jeff Walton. It's the week of Thanksgiving, 2025, November 24th, episode 37. And I don't think there's any shortage of stuff to talk about between MSCI, macro maybe versus sentiment, Bitcoin Twitter rallying behind MSTR, Bitcoin-backed credit weekly volume charts making their rounds up and to the right. And of course, Fed governor, not federal, Fed Governor Waller saying he's advocating for an interest rate cut at the December meeting. Jeff, did I miss anything this morning? It looks like no additional purchase from Strategy, but we did get the volume chart out there posted.
Yeah, first week in quite a while with no purchases from Strategy, which not a huge surprise given there's a lot of volatility in the market, particularly on the prefs. And I think they've indicated in the past that, when there's weakness in the equity, they're not issuing equity. And there was weakness in all of the equities, including the preferred equity. And we saw some volatility in both of those. So not particularly surprised. Nice to see Bitcoin rebound a bit coming into this week. I think as of right now, it's around 89,000, which, saw a drop all the way down to 80,000. And I mean, all things considered, the preferred equity performed incredibly well. It was significantly less volatile than the common equity, right? We've seen a lot of volatility in the common equity, but as anyone that's holding, and per our conversation last week, right, if you have a fixed income instrument, you expect some volatility in it, and there was a little bit of volatility, but there's really holding strong, all things considered.
Yeah, I agree. I think the first principles of the instruments held up, right? You would expect that the stripped down volatility from Bitcoin at the preferred should have less volatility than Bitcoin, but should have some. They had some. I think that when you look at it compared to liquidity events in high yield space, there's nothing out of the ordinary, and you see that the yield that they offered, they're still great. And amplified Bitcoin traded like amplified Bitcoin, right? That this works in both directions, and it, to me, it just shows that this is not magic. This is structured finance, and structured finance ultimately is a lot of math. It's a little bit sentiment, and that these structures are held in place. And what's always interesting when these liquidity events, these down markets happen, is some of the FUD that pops up of, I can't even tell you how many posts I read is Strategy about to sell its Bitcoin. And it's just like from big accounts that you would think would understand the structures, that they're actually commenting on it. And it kind of showed me just how early we are in explaining a lot of these things. But ultimately, it held, and now you have Bitcoin rebounding right now, and who knows where we go from here. I mean, it seems like at least in the short term, this was a pretty strong rebound off of 80. So it's hard for me to not feel at least some short term optimism. But ultimately, everything is in place structurally from the zoom out 4-year perspective that we talk about on this podcast every single week. I know, Ben, you bought some Bitcoin. I bought some Bitcoin. Enjoyed stacking some cheap sats, and ultimately, like Alfred, it's like, if I talked about, if these things go lower, we'll just buy more. That's ultimately how it will go.
Yeah, I missed my last purchase. It was at 79.7, so I was hoping to buy below 100, buy below 90, buy below 80, but everyone else stepped in before it got there. So, but these periods in the market are always fascinating because it feels like deja vu if you've been around for a while, right? You can kind of rewind back to every drawdown that we've seen in the space, and the same narratives pop up every single time. This time, obviously there's more, but it was getting recycled from the past, which I think was interesting. We'll talk about that a little more with the MSCI news, which really was actually old news that was just getting amplified and recirculated again here from about a month ago. That came out in October. But what I always find interesting is the focus that people shift to liquidations, and they seem to equate cost basis with liquidation price. And they think there's some magical reason why Strategy would need to start selling Bitcoin if it goes below their cost basis, which just isn't real, right? When you look at
it's just so irrational.
It is. At this stage, it is, because this has been a strategy that's been along for a while. We've been through these cycles before. We've seen the drawdowns. They're always painful. Nobody likes these, but it's not anything out of the ordinary. I'll say what was most out of the ordinary from this drawdown was that you can't really point to a single catalyst that caused it. When you look back at the history of all the drawdowns that happened in Bitcoin, when you were seeing particularly the 30% drawdowns plus, you would typically see some catalyst that kind of ignited it. The last one obviously being the blow up of, BlockFi, Celsius, FTX, right? That whole cohort that caused contagion. You look back even more recently, you had that sell-off that happened when the stablecoin broke its peg on Binance and it caused all the liquidations in that ecosystem. But there's usually a catalyst you can point to that drives it. And you didn't see the same thing here. And the FUD actually really didn't amplify, at least from what I was seeing, until we were kind of sub 90K. And once we got sub 90K, it got really loud. And that was when, to Matt's point, you saw the big accounts starting to post about it, right? It was all these accounts with 400,000 people, 500,000 people. And I don't know that that's necessarily like a coordination thing. I don't think it is. I just think that when you start to see what's trending out there, all these big accounts start to jump on it because that's where the engagement's going to be. And I think they're just recycling whichever narrative it is that they're picking up. So I don't think most of these accounts are actually educated in what's going on here, because we've seen individuals that you would expect to be sophisticated on what's going on, particularly in terms of the risks of things like liquidations and all that you would expect to be more well-versed come out and prove that they're not. So it's always a bit of deja vu when we have these drawdowns, because you find yourself getting pulled into fighting the same narratives that have been happening now for years. And every time these things bounce back. So, I always look at this and you just take the opportunity to go out and buy more Bitcoin, right? I've got my single rule, which is every time Bitcoin makes a new all-time high, I better own more of it than I did the time before. And that's as easy as it needs to be. And so when you get these big drawdowns in the 30%, it's, when you turn it back on, you start buying again. So we'll see where we bounce from here. We had a lot of flushing that happened in the leverage. So a lot of the leverage came out of the system again. There's a fair amount of leverage actually above us. So we'll see if we start chipping into that here at all. But the bounce off 80 was quite strong. I mean, it reversed pretty quickly and it bounced pretty hard. So I would expect that we kind of stabilize out here, probably in the high 80s, low 90s as that structure builds back up again, and then we'll see where we go. But I think the FUD was overblown. You're always looking for the companies that are blowing up. We haven't seen that. And I think that particularly in the Treasury space, the one thing the market always misses is that the leverage, and particularly the leverage that has triggers that could cause you to blow up, is very minimal in this space. So when you get a flush like this, sometimes the answer can be just do nothing as a company. You can wait, right? Because if people are spending their money and they're having the borrowing cost to drive things down, that costs them capital. And so they can only hold those positions for so long. So as a corporation, if you find yourself in one of these positions, one of the options is just wait.
And I think that's where a lot of people make mistakes, is actually feeling like you have to do something, and or even simplifying that it's super easy to just wait. It actually is hard. Waiting typically is more of a saying no with a much higher frequency while looking at things than just sitting there, right? Like you're always looking for opportunities, and this is something that Saylor has hammered in kind of private group meetings that I've been in with other, executives from Bitcoin treasury companies, where it's like, you can do nothing. If you have Bitcoin on the balance sheet, that is an option for you. And I think when you don't, that's when you get into the things like taking bad debt terms or strategic decisions that could really have long-term negative implications, right? When you look at some of the Monte Carlo simulations of Bitcoin returns, of how do you model an asset that might have a 30% CAGR with a 30 to 60% vol, and you run thousands of simulations. Some of the simulations will be simulations like Bitcoin, like from here, goes down to 60,000 or 70,000, and then it recovers. Like that's within the normal realm of options for this type of volatility asset. It's not a prediction. I'm not predicting that happens. I'm just saying that would be in the course of normal for what you would expect for an asset like this. And so as a company, you're already modeling that as something that you're prepared to weather. And we are, strategy is, and I'm sure many others are. And hopefully we all hope it just goes up and to the right. And I think there's a good case that that's the most likely scenario, but you're prepared for the downside as well.
That's the reason so many companies really struggle holding this, or even people, right? Because it is a high volatility asset, even though, you zoom out and it's going directionally up and to the right, but everything you had to go through to get there is right. You've got to ride it all the way up and down and up and down, and you've got to go through that whole business cycle, which is tricky and it's very difficult to do. I mean, I'm not gonna lie, I got a few phone calls from family members on Friday asking what's going on with Bitcoin, right? And I just had to say I'm still holding here, right? I'm still directionally long. In fact, this looks like a discount to me. Like if you were to walk into a grocery store and all of a sudden all your groceries are 30% off, would you be excited? Yes. But when it comes to like stocks or assets, people take an alternative perspective. It's fascinating. But Ben, I want to hit on one thing here with this, not a single catalyst. And I think maybe this MSCI, I guess, mandate that came out in October may have been the catalyst. And it may have just already happened. And over the course of like October and November, like already being priced in, right? Efficient markets hypothesis. You have to think about the game theory here. And if you're holding like the MSCI index or tracking it, you are incentivized to front run that decision. So you have to make some probability assumption of what the decision is, and then front run it. Right? Theoretically. So I wouldn't be surprised if there's a decision made in January. So for those that aren't necessarily tracking, I don't see how you couldn't be, but MSCI came out. It sounded like they are contemplating removing any company from the index funds that have greater than 50% of their assets held in digital assets. So some of the companies that are hit the hardest are Strategy, Metaplanet, Capital B, Bitminer, if they're in there as well. There was a list of, I think, about like 30 or 40 companies that were on the list to be removed. And so, if you think about front running that decision, you have to take into consideration some sort of probability that it does happen. Because if you wait until January 15th when they make the decision of whether to include them or not, you're already going to be behind if everybody's selling on January 15th. So that's tricky to contemplate as a large institutional holder. Like you have to take these things into consideration. I mean, Matt, I'd be curious to get Matt or Ben, curious to get your perspective.
Well, I think I just pulled up the chart to look. And so the MSCI news came out on October 10 was when it originally launched, and Bitcoin had a negative 12% day that day. So yeah, you're probably right. That probably was the initial catalyst that kicked off the weakness. Obviously, it's extended far beyond that, but October 10 was a deeply red day. And I think that just the fact that MSCI has such an institutional level impact out there could certainly shake people out of their interest in acquiring and holding Bitcoin during that time period, right? If you're starting to see companies being adversely impacted, or if you're a large holder in Strategy and you're an institutional holder in Strategy, I could see where that kicks off a flywheel effect that drags everything down, right? You start getting the conviction rattled in Strategy if you're looking at billions of dollars coming out of that ecosystem. Plus, you've got all the derivatives complex around it coming from all these ETFs that have spun up in the ecosystem around Strategy. Like there could be a serious unwinding of positions in there. And because Strategy is such a massive figure around Bitcoin, right, it can have impacts in both markets. So, looking at the chart, yeah, I would say you're probably right. It probably is MSCI that kind of nudged this. and kicked it. But I don't remember this being massive news on October 10. Maybe I need to go back and look at it, but
It wasn't.
behind the scenes, it may have. Right, to your
Yeah.
point, it may not have been big news in the retail community because it kind of got brushed because October 10 was also the day that the wipeout happened with Binance.
Right.
So you've got two catalysts there, I guess. So it's almost like that news got swept in alongside of Binance. So I'll put Binance as number one for triggering the initial drawdown in the market. And then you get the news around MSCI and the time that it takes to digest that may have started drawing capital out of there. So two catalysts one day, one obviously much louder than the other because I don't remember talking about the MSCI news.
No.
No, I didn't. I don't remember talking about it either. And so I do think it was swept over. But people that use MSCI indexes, that would have been maybe the only email they got from MSCI that day, right? So like for people that are customers of MSCI, which are, we're not a customer of MSCI, even our asset management business. We use Bloomberg as our index. Now, funny enough, we actually own MSCI in several of our ETFs, but that's just because they're passively managed and MSCI is a publicly traded company. But you look at some of these charts and a lot of technical levels of support broke down on that day. Like Bitcoin versus MSTR, like actually lost a very substantial level of support right when that happened. And so did this play part into the story? And people, I'd say, it's not inside information. It was people that had public information that had a better view of it than others were able to act on it. Very plausible, actually. And it gets into a point that I wanted to make, just so, as at CalPERS, we used MSCI. We were a customer of theirs, and I didn't work with them as closely as I did with people like Bloomberg, but we had a lot of people there that did, and when they made changes like this is not actually that uncommon of a thing where they take an index and they make changes to it. Usually it revolves around countries, and countries that are involved in like terrorist activity being removed, or Russia being removed from the broad-based indexes, stuff like that. And how this typically works is that the markets are forward-looking, so it ends up getting priced in before the index removes it. So and it kind of makes sense, right? Because you take the passive index holder, they're kind of stuck in the asset. So the markets that are active, they sense forced selling, and so they get in front of it. And then when the actual selling happens, it's how you get things like, you buy the rumor, you sell the news, that sort of stuff. Is that people are already pricing this in now. That said, I don't think it's a foregone conclusion that this change happens. I think the momentum is definitely in the direction of this change happening. That's, I think, what you're seeing in the price of MSTR. But I have seen instances where MSCI will put this out there for comment, and then they actually don't go forward with the change. Like if they already knew they were going to make the change, they would have just made the change.
Mhm.
Like that is earnest. Now, when they come out there with a comment that we're considering it, it's probably because several of the users of their indexes made this request to them and they're taking it seriously. They're leaning into it, but they're trying to move slowly, not quickly. And so I think the best way to change action here is to actually do a large scale education process of why Bitcoin treasury companies are operating companies, why making this change would hasten and damper innovation, all the different arguments, and there's several different layers of arguments that could be out there, really developing them, publishing them, get the word out there. And I think that is the really the only hope, but the best chance that we have of making a change. And, oftentimes in this space, in the good times, we'll talk about how you can just make things happen. Can we just make this happen? TBD, but can we put forth a really good, compelling argument that it's going to make them think twice? Absolutely. And I think that is what this industry is called to do over the next month, is really make this a difficult decision for them. And I ultimately think it is. It's not, for us, it's not talking our own book, or it is, but it's because we have conviction in this, right? That we have conviction of the opportunity of operating companies that are Bitcoin treasury companies. It's what we cover all the time. And these are operating companies. Think about the securitization of finance that MSTR has done. You don't do that as a hedge fund. You do that as an operating company. They underwrite Bitcoin risk every single day. These are complex operations. And I think that, through education, we can potentially win here. And if we don't win here, there's going to be continual battles because there's many different index providers. Every single day, Jeff Walton puts out the S&P 500 MSTR presentation, right? S&P could make a different decision than MSTI. Bloomberg, who we use for our indexes on our asset management business at Strive, they've actually leaned in as a marketing effort that they're rules-based and that MSTR has been in their indexes early and how that's helped them outperform. So I would be surprised if Bloomberg made the opposite decision. I think they're actually leaning into having strategy in their indexes already. So it's not going to be one size fits all. And I think we have some work to do.
I think you make a really important distinction there. That is, the Bitcoin treasury companies don't need the indexes. The indexes need the Bitcoin treasury companies. Like the constituents that hold these assets, if they exclude this innovation that's happening in the capital world, you're losing that portion of diversified exposure. It just kind of goes against all like finance theory ever, which is a fascinating development. And I'm just going to read one sentence here from this announcement because I think this is I think it's fascinating to frame it this way. But so they announced today an extension of its ongoing consultation with the investment community on the appropriate treatment of companies whose primary business involves Bitcoin or other digital asset treasury activities, including cases where capital raising activities are primarily used to fund digital asset accumulation. I'm going to say it again, where capital raising activities are primarily used to fund digital asset accumulation. If you would remove digital asset accumulation, and if you were to say where capital raising activities are primarily used to fund real estate or commodities or oil or stocks or anything else, this would seem ludicrous. But it's digital assets. It's new, it's foreign, it's different. And I think that's one of the most fascinating things here is like this isn't rational. This isn't and I think that's what, Matt, where you're saying like we need to go on this educational campaign a little bit beyond what we've done here so far to talk through, what these companies are doing and how they are securitizing finance and how they are providing, interesting securities that are attractive to multiple different portfolios, improve returns of portfolios, improve the downside risk of these portfolios and the benefits of holding Bitcoin or Bitcoin securities.
Well, it's going to raise the question of how are you defining primary operations of the company, right? So are you now ignoring completely the income statement, right? Where are they going to look at what the change in fair value is as a percentage of that now? Are they looking at expansion of balance sheet? Like, how are you defining what the core operations of those businesses are? I mean, Strategy has a $500 million software business, and they're writing that off like it doesn't exist, right? So I think that that's going to put them in a really tricky place. Because what if you are just another operating company that every dollar you retain, you put into Bitcoin and you're building up your balance sheet, and all of a sudden, because of appreciation on that asset, it becomes more than 50%. All of a sudden, you're going to get thrown out of these indexes, right? Like it just seems like a very tricky thing to defend over the long term. I get right now, they're still in that period where they can call this speculative, right? Digital assets and they're not differentiating between the digital assets, even though it's very clear that even within the space, there's a clear delineation between Bitcoin and crypto or other digital assets. But it is a big shift in convention because typically when they look at how they're going to classify your business, it's based on percentage of revenue that it makes up. And that would typically be what they look at to classify you. So this seems like a departure from the norm, which, to Matt's point earlier, I think is what opens this up to scrutiny. because now they really need to be able to defend that.
Yeah, and maybe to take a slightly different take to one of the things you said, Jeff, that's pretty aligned but slightly different of, strategy does not need MSCI. MSCI needs strategy. But I think for other companies where I think it could really constrain innovation is that for a company that might be struggling, maybe that's in an MSCI index today, and they realize that putting Bitcoin on their balance sheet could help save them in the future and help put them from a position of strength. Maybe it's because of AI risk for whatever reason. And then they are disincentivized from doing that because they don't want to fall out of the index. They might have otherwise made that decision. They decide not to, and then they fail because they're trying not to lose a major investor that they have today, right? Where it's like you look at us as an example, like we're not in the MSCI indexes, so there's not an investor that we lose by like exclusion from the index. You look at strategy, like they're in such a strong position from their balance sheet already. They don't need MSCI investors. They'll be fine. Like obviously, like it might cause some selling, but like they're not. It doesn't not at the end of the day, it's not really going to matter. But when you disincentivize decisions for a business that are legitimate decisions to strengthen them over the long run, then that can constrain innovation. It can constrain flourishing of a business, which could ultimately harm. I mean, for like American companies, it could harm American businesses. That's dangerous, and I think it should be avoided. But you never want that to be an index that's driving the decisions of businesses. That is should be the opposite. And as much as I want to talk about obviously how great Bitcoin treasury companies are and DATs are, that are doing other cryptos are a joke. Like from a passive index perspective, like let the market speak. Let the companies that make bad balance sheet decisions succeed or fail on their own merits. I wouldn't even agree with including Bitcoin treasury companies, but excluding Ethereum ones. That's not the role in my view of a passive index. A passive index is to say, let companies succeed or fail on their own merits, and we're not going to be making those active decisions. That's what an active management is for. And ultimately, I don't think that you're going to see a lot of DATs that are not investing in Bitcoin exclusively maintain the market size to even be eligible for indexes. So I think it fixes itself is my view of this.
Free market.
Free market.
Free market. I think one of the most surprising things in my mind is just if you take a step back and you look at just the regulatory environment and how much Bitcoin has really been de-risked, right? You've got Bitcoin ETFs, the derivatives market's huge, largest growing ETF in history, strategic Bitcoin reserve executive order. We've got a crypto czar in the White House, right? Like you look at all of the landscape of this market, and it doesn't make sense on like how this was a logical decision from an American-based company that's been following, if you've been remotely close to following what's going on in capital markets or what's happening in the White House, this decision seems strange. And I mean, while we're at it, MSCI, and I did this, we were talking about this beforehand, MSCI, the company based in, I think, New Jersey or New York, they have $5.3 billion of assets on the balance sheet. 54% of that is goodwill. So $2.9 billion of the assets on their balance sheet is goodwill. Another 16% is intangible assets, 869 million. So you've got like 72% of their balance sheet is either goodwill or intangible assets. And now they're attacking companies that are holding 50% more of their balance sheet in digital assets. It just seems a little ironic.
Thank goodness it's not in Bitcoin. They'd be at risk.
They would be at risk of excluding themselves from the index. Yeah, it's crazy. And MSCI is like 130% leverage ratio. They've got $6 billion of debt. They're, I think, ranked 240th largest U.S. company. And on a comparison basis, you compare strategy and MSCI, and strategy is, 10 times stronger from a balance sheet perspective than MSCI, even more, 10, 15, 20 times stronger than MSCI. And yeah, it just seems odd. This whole thing seems odd.
People are always scared of what they don't know, right? I mean, this approach, I think we can all even acknowledge is new, innovative, and scary to traditional finance minds, right? It doesn't make sense if you haven't put in the time to understand the asset itself. If you're just hearing that, there's these digital currencies getting created, now companies are out capitalizing themselves on it, and you'd never spent any time figuring out what problem they're solving for, this would be scary, right? This would be something that concerns you. But when you spend the time to figure out how purpose made this is for one of the largest problems that we face today in finance, for corporations, for individuals, this seems like one of the more responsible approaches you can take. Yes, you're going to have to ride volatility. That's a part of the maturing of an asset class. You have to be ready for the fact that you're going to have these explosive run-ups and these explosive drawdowns, and you have to be ready to be uncomfortable. That's how you get the outsized returns, right? You have to slide slightly out that risk scale while you're doing this. But when you realize the problem you're solving for, it quickly alleviates that concern. And to all the things you mentioned before, Jeff, about how broadly accepted Bitcoin is becoming, it does feel strange that we're running into this friction now, right? You're seeing the regulations show up. You're starting to see maturity coming to the asset class. You're seeing adoption out of the administration. Some of the most powerful people in the world are some of the largest advocates that are out there. Like, it does seem like this is a step back for MSCI to be taking this and to kind of go in the face of everything else that's been happening. We've got accounting clarity, we've gotten regulatory clarity, we've gotten administration supporting it now, looking at potentially adding it in reserves. Like, you just have all this momentum happening, and now this happens, right? And I think I'm certain it's driven because there's been this massive explosion of companies entering the market, right? That's most likely what's causing that concern. When it was just one, it was kind of a nuance, and now you're seeing an industry building around this. And I think that probably started to raise questions, right? Yeah, strategy had been successful, but now you have all these other companies coming into this. What are we going to do when they all achieve the size to enter the indexes, right? Do we include them all? Do we exclude them? And we can't make exceptions, so maybe we need time to review it. I think that they probably take the risk off approach to this, saying, we don't understand it right now, we think we should exclude it. But to Matt's point, in America, this is around free markets, right? This is letting the market decide. And the market will decide on most of these companies pretty quickly, right? Either those companies are going to put in a sustainable structure that allows them to execute on this strategy and scale and grow and deliver shareholder value, or they won't. And if they don't, you'll see them shrink massively in size. If they, build their foundation on sand instead of rock, they're going to have a very different outcome, and that's going to force that naturally to fall out of a lot of these indexes. To me, it just seems like with the stage we're at in innovation right now, and with the way that Bitcoin has proven itself, over a long period of time now, you have to let the markets decide this. I don't think it should be forced within some boardroom somewhere now.
I agree. I don't have anything else to add on that, but
as fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private.
I would like to talk a little bit with you guys about this Mike Green article that I think hits on what we used to talk about, I think, a lot more in the early days when we started doing the hurdle rate of just kind of where we are as a society. And this article really took off. It was about the poverty rate and what kind of income level defines the poverty rate, and the K-shaped economy. Why do people feel the way that they do? And it just took off. And it's interesting if you don't know Mike Green, he's a Bitcoin hater. Him and I have debated in the past on some Twitter Spaces about ESG and indexes and Bitcoin. Anyways, he's definitely an intellectual. I would say typically we're on the other side of most arguments, but I respect him in the sense that I think he's an intellectual and he tries to put forth real arguments. He's not just a troll on Twitter putting forth, nonsense, even though we might disagree. And I think so. So he hit on a key point here is that the rate that poverty is defined as in this index is 3 times what the average food bill is. And so you think about where we are today as a society, what costs have ballooned and what costs haven't, that food is not the cost that has ballooned. It's actually all the other things. It's health insurance, it's the cost of education, it's the cost of childcare, it's housing. And so he put forth a methodology to try to fix that and came forth with a mid $100,000 figure that basically was how he defined the poverty range. And now you have a lot of people debating, is that the right number? Is that the not the right number? But I think the reality is that it definitely is substantially higher than what is reported. And everybody kind of related to that. Everybody kind of realized that, has felt that at different times, unless you've grown up in money. I know earlier in my life, I definitely felt that. And you look at different stats out there, and one of the stats that I always come back to is children. How many children are we having in society? Why are we having less children? And so I pulled up one of the stats, and it's in 1976, for every 1,000 women aged 40 to 44, we had 3,000 children. So 3,000 children per 100 women. So call it just over 3 children per woman. And that's declined now to under 2. So under basically the replacement rate, given that it takes a man and a woman to have kids. And if you have less than 2 on average, that society is decreasing in the United States because we're not having enough kids. And you say, well, why are we not having enough kids? And it's because of this. It's in my belief. I don't think it's that we as a society have grown to not like kids, that we don't want kids. It's that kids are hard to afford. And it definitely, it played a role in when I had kids. You need more money, you need more financial security, and it's different than what it used to be. And so we are as a society, I think, have a lot of have nots, and I think it's really has a lot of implications. I think it's core to the Bitcoin thesis that Bitcoin was an opt-out. It was something that people saw as an opt-out from a system that didn't work for them. You see other things like Mondani and him being elected as the mayor of New York. I think that's a different, and I would say obviously the wrong solution, but to a similar problem that people don't see the society as working for them. And so I think that it really took off, and I think it makes sense why it did.
This article resonated a lot with me. Just growing up, I was working in finance. I graduated from a great college. I didn't have huge student loans because I had some scholarships and things like that. But I worked in finance with a good paying job and not too much student loans. And I still felt like I was running a rat race. I wasn't getting ahead. I wasn't moving anywhere. And the kid equation was really interesting because everybody would ask when are you having kids? And I'm like, I'm not taking on personal financial bankruptcy risk to have a kid. I can't I don't have family that I could fall back on, right? I can't go live in my parents' basement. That just didn't exist for me. So it's if I have to do this 100% on my own, the math just doesn't work. And that's one of the reasons that drew me to Bitcoin, honestly, is because it was this ability to opt out and see a different way of doing things. So yeah, as somebody who's living through this, this resonates totally. And you could see it everywhere. Even the polarization you see in politics today, each side is pissed off at each other. And, we're seeing like the political regimes, swing in one direction, and then like nothing gets better. And then it just makes both sides pissed off at the other side. And because nothing is necessarily getting better. And I think that's just going to continue probably.
Well, I think you read that article and it's a little terrifying
Totally.
because you look at the figures that are presented. And I think the figure that was in there for poverty right now is something like 31,800. And so you look at that and you go, all right, well, someone who's making double that is probably doing fine. But I remember it wasn't that long ago when I came out, got my first job, and I was a credit analyst at a bank during the global financial crisis. And I think that the starting salary on that was 37. Like it was really low at the time. But it felt fine at the time. I was just coming out of college. You're excited to have a job. I've always had the benefit of, my parents have been supportive, and, I'm not going to say I didn't get advantages in life. I certainly did. My dad really valued education. He was very supportive of getting his kids set up to launch in the best way that they could. I've been very fortunate. And I look back and I see people coming out of those situations where you come out with student debt and all this overhang that you have. And on that salary, there's no way I could swing it. I go look and say, if I had to come out into that environment and go buy a house, right? If I bought a $200,000 house, which would be a very normal house these days in lower cost areas of the country, that's probably with taxes and utilities and stuff, you're probably looking at $1,400 to $1,500 a month. Well, that eats up more of that income, more than half of that income. And now you've still got to pay for health insurance. You've got to get food. You've got to put back gas in vehicles. You have to maintain vehicles. If you ever want to have a single minute of fun, right, you need something to do. I mean, there's just so many draws today that I don't think and I think he talked about this in the article, that there's just so much more overhead that showed up today than there used to be. Right? It's all the healthcare costs that have ballooned. It's the childcare costs that have ballooned. It's the housing costs that have ballooned. Everything has just rocketed up, and so much more of it is required as a standard part of maintaining your lifestyle. And so you read an article like that where it goes and normalizes it, and I think it put it in the 140 to 150 range would kind of be the equivalent today if you were following from the time when they struck those rules. I mean, that is disheartening. But what it does is it explains why there's such a disconnect, because you hear these figures, you hear, well, the poverty line's 31.8. So if you're making 75, you should be fine, right? You hear that disconnect, but you don't actually go back and normalize it to make it the same thing today. And then when you do, you realize just how many people are hurting really bad. And it starts to explain some of the trends that you've looked at for so long and thought, this feels really weird, right? Like it can't just be one thing. When you look at the amount of replacement in children, like you see that, and it was really tough to explain for a while. But when you read that article and you realize just how hard just making the bare minimum has been for people in society today, like you start to understand and you start to have a lot more empathy for that. I think there was a period in time where there was actually a lot of criticism going around for people that were choosing, not to have children. But I think for a lot of people, they looked at it and thought, well, what type of a life could I provide for a kid, right? If I'm already struggling, if I'm just beaten down by stress and I'm paycheck to paycheck and I'm trying to, make sure I can pay my mortgage, if I bring a kid into the world, what am I putting them through? And I think that's a part of that decision process that the human side of you really has to process first to understand why people are making that decision. And it shows that, we've got a real problem in society right now that, needs to be addressed. And, obviously we always bring everything back to Bitcoin, but, I think this one also goes a lot further than Bitcoin. I think it shows that you have to give yourself all of the financial advantages you possibly can, which is where we look to Bitcoin as, protecting yourself from that erosion and that purchasing power over time to the best that you can. But I also think it's going to play a part in the reason that people start to really view higher education different. I think that's going to be a really tough sell for a lot of people, because when you come out of a university, and you've got $150,000 of debt that you have to pay back, I mean, you effectively have to pay off a mortgage before you can, get rolling. I mean, what a drag to have on your life. And I think a lot of people now, when you look out, there's a lot of reasons where people can throw up their hands and give up, right? And just say, well, the system was stacked against me and what could I do? But I think we're at a point in time, and you saw it with Palantir coming out and saying that they're effectively offering high school students the ability to come work at Palantir in what's like a 4-year program where they can get on the ground experience. And then in 4 years of doing that job, they'll get a full-time job with the company. That's a shift away from the higher education. And so I think you're going to see some rather large shifts from what used to be the norm, right? It used to always be that you go to high school, you go to college, you get a degree that's going to set you up to get a good job, that's going to give you a good life. But those economics have changed, and they've changed pretty dramatically. So I think we're going to see some fairly radical shifts in the way people choose to launch themselves, over the next 10, 15, 20 years. I think we're going to have to.
When I was an analyst and I got my first job out of college, I made $52,500. M2 money supply adjusted, it's $105,000. And I know new analysts coming into the market are making 25% less than that. And their student loans have increased at the same M2 money supply. Like their student loans are also up 6.5%. So it's just the math gets incredibly difficult, and there's strain everywhere, even in, what would historically be like a good, like high paying job. It's happening everywhere.
Cost of living raises aren't cost of living raises anymore, right?
Yeah.
Giving someone a 1 to 3% cost of living raise does not replace the cost of living from what was lost in M2 expansion.
Jeff, when was that when you started?
2014.
2014. Okay. So 2014, just as an example here, the 10-year Treasury was about under 2.5%, which means that now it's about 4. So the interest rate, so mortgage rates are most based off of like the 10-year. So we're at least 150 basis points lower. They're actually more than that because the Fed was doing QE. So the spread between mortgage rates and treasuries was also lower. So it's probably 250 basis points less in mortgage rates. Home prices are also up dramatically. So not only has the M2 money supply eaten away at what you would have earned in today's dollars, but the world has gotten drastically more expensive as well with regards to things like housing, right? Where housing has had a double whammy, both of higher interest rates, higher mortgage spreads, and higher home prices. So I mean, people, it just, and I would say even in 2014, it didn't really work then either. Like it's not like when you started your career that, things were affordable. You could have, you could have just had kids and it worked. No, it didn't. You just said how it didn't. And now it's even worse. Right. And so you just see the problem, and it's really, it can't be understated how big of a problem this is for our society. And, I think within the Bitcoin community, you see some of the better versions of this, right? People that have opted out, a lot of people have done well for themselves, have created financial freedom for themselves. But that is just not the world that we live in as a whole. And so I think we have to just expect continued issues in our society to work through that people, I'm a big believer of capitalism, but you have to really meet people where they are, that this system has not worked for them. And we could argue why we haven't actually seen real capitalism, how the Fed has stepped in and distorted markets in ways that actually are not free market capitalism. But it's not surprising to see them, willing to throw it away, because what are they throwing away for themselves? Nothing.
Yeah, people forget that it's a luxury to be able to take risk. Right. So for a lot of the people that we meet, we engage with, or the people that are investors in these companies or that have been investors in Bitcoin, you had to be at a point where you were at least secure enough to take some level of a risk. And I think that's what we overlook a lot when we're trying to educate people on Bitcoin is, to Matt's point of where you need to meet them where they're at. A lot of people are in a position where they don't feel like they can take a risk. And so part of that education is trying to help them understand why this isn't necessarily the risk they think it is. It might be the lifeboat that they're looking for. And it's a journey, because it's really hard when people are in a position where they feel vulnerable to really negative outcomes to be able to even have that conversation, right? When you're effectively telling someone, let's talk about personal finance and why this should be a part of your personal finances, that's a tough sell if you're worried about next month's mortgage, right? And when you do get a little bit ahead, you try to protect it. And protect it, unfortunately, for a lot of people means they hold it in cash. And they're going to hold it in cash for as long as they can, because they feel like that's the safety net, when really, that's what's draining all the purchasing power over time and continuing to put them in a position of weakness. So I do think that there's a part of the Bitcoin education when we push it is it can't always just be, number go up. That's not always good enough for people, because they would look at a period right now and go, that's a wipeout, right? It's not just that I'm down 30%. It's that I put money in there that I needed next month to pay the mortgage, and now there's 30% less of it, right? That time frame didn't work for me. So there is a level of responsibility that I think everyone in this community has to make sure that you're meeting people where they are at, and you're trying to work a way where Bitcoin could be a solution for people based on their current standings. And quite frankly, I think that's where digital credit starts to come into this conversation. Something where you can have more stability. It's getting a track record now of being out there. It's been through some drawdowns. It's been through some volatility. It's got dampened volatility, but it's still got really good. I think that these types of products coming to the market are going to help to fill that void for people in their everyday lives. And I think that's a really important part of the mission here, right? It's not just about corporations. It's just not just about speculating on equities. It's about getting products into the market that make a difference in people's lives, that are enabled by a transformative technology. And I think that's a really huge mission, and it's one that this entire sector, I think, needs to take very, very seriously, because we've got a real chance here to do something really impactful.
Redefining risk, taking risk.
And sometimes stripping it off.
Strip off risk, yeah.
Right.
Take risk. Mm-hmm.
Yeah, you let the people who can take the risk absorb the risk, right? That's what happens in the common equity. You're stripping the risk off the preferreds. That gets passed down to the common equity, the people that want the outsized returns, that are willing to take the outsized risk. There's an investment vehicle for them. People that need more stability, more certainty, you create the products for them. So there's going to be a lot of creativity in this space, but when you do it correctly, I think it can have a really positive impact, on society, and people that might not think they have hope or might not be able to jump directly into Bitcoin. You might be able to create products where Bitcoin enables success for them in the future. And I think that's a pretty worthy cause.
It sounds like a good place to wrap it. Happy Thanksgiving to everyone. Hope everyone has safe travels and awesome time with family and friends. For Ben Workman, Matt Cole, and Jeff Walton, I'm Tim Kotzman. We'll see you next week here on The Hurdle Rate.